Selamat pagi, salam sejahtera, selamat datang. Good morning to all of you. Yang berbahagia Tan Sri Abdul Wahid Omar, Chairman of the Advisory Council of the Economic Club of Kuala Lumpur and the moderator for this morning's webinar, our distinguished speakers, ladies and gentlemen. On behalf of the Economic Club of Kuala Lumpur, I'm pleased to extend a very warm welcome to all of you to this webinar, a series that is organized by our ECKL's Youth Committee to share knowledge, to discuss trends and key issues on a wide range of topics and issues that we will be presenting from time to time. We are very delighted to hold this webinar this morning, focusing on private equity, which is a very key and appropriate topic in these very challenging times. And we have got a very distinguished panel with us, including a very old friend of mine, Mrs. Lim Hwee, the former Second Finance Minister of Singapore and Managing Director of Temasek, and now Managing Partner of Tembusu, and also to be moderated by Yang berbahagia Tan Sri Abdul Wahid Omar, who is currently Chairman of Bursa, Malaysia. The webinar will also be live streamed on the Facebooks of both the Economic Club of Kuala Lumpur and of KSI. So we do hope that there'll be a lot more people who will be watching on live stream and will be joining us also on this webinar. So without any further ado, may I now hand the floor over to our moderator, Tan Sri Abdul Wahid Omar, to start the webinar and to introduce our distinguished speakers. Over to you, Tan Sri.
Thank you, Tan Sri Michael. Assalamualaikum and a very good morning. Thank you, everyone, for joining our Economic Club Kuala Lumpur webinar this morning on the opportunities and challenges in 2021 for private equity in Asia. Now, we are indeed truly privileged to have three distinguished speakers on our panel this morning. First, we have Mrs. Lim Hwee, the co-chairman of Tembusu Partners based in Singapore. Mrs. Lim is a former minister in the Prime Minister's office, and prior to joining the Singapore cabinet, she had served as the managing director at Temasek Holdings, where she oversaw the investments, restructured companies and boards, and sat on several boards, including PSA, Keppel, and Mapletree. She's currently engaged in private equity through Tembusu Partners and KKR, and financial services via UOB. And she's also a distinguished visiting fellow at the National University of Singapore's Business School and the Lee Kuan Yew School of Public Policy. Mrs. Lim graduated in mathematics and engineering from the University of Cambridge and obtained her MBA from the Anderson School of Management, UCLA. Mrs. Lim has written two books, Government in Business, Friend or Foe, in 2014, and more recently, Government in Business, Leading or Lagging, which we hope to hear a bit later in our conversation with her. Next, we have Dato' Ganen Sarvananthan, the co-managing partner of TPG Capital Asia. Ganen joined TPG in 2014, and he is very much a distinguished investment professional, having spent some 10 years at Nasional, where he oversaw a team of more than 100 professionals in investments in Kuala Lumpur, Beijing, Mumbai, San Francisco, and Istanbul. Prior to Khazanah, Ganen was an investment banker at UBS. Now, I had the privilege of seeing Ganen in action, both at UBS and Khazanah. And I must say, Ganen, one of the main things I appreciated is the way you supported Tan Sri Azman Mokhtar in building Iskandar Malaysia to be very easy. So I think in the initial stages when I was at UM, there were some challenges, but I think you actually drove Iskandar Malaysia significantly at that point in time. Thank you for that. Now, Ganen serves on the board of Property Guru, the Healthcare, CVS KL, the Cardio Center at KL Central, Pathology Asia, and Apollo Towers. Like Mrs. Lim, Ganen is also a UK graduate from the University College of London. Our third speaker is Syed Yasir Arafat, the CEO of Ekuiti Nasional Berhad, Ekuinas. And prior to joining Ekuinas, Yasir was with ING for 9 years, starting as VP Corporate Finance and ending as Country Manager for Wholesale Banking. Yasir has also previously served at UOB Malaysia, Dana Harta, CIMB, and ASEAN Bankers, now known as Maybank Investment Bank. Now, I have the benefit of working with Yasir when I was in government, since Equinas was one of the agencies under my portfolio then. And Yasir graduated also from the UK, from the University of Essex in accounting and finance. So, ladies and gentlemen, we have a good set of 3 speakers from various backgrounds that will add some diversity to the conversation that we're going to have this morning. So back to the private equity market here in Asia. Now, wearing my Bursa Malaysia hat, I would say that the equities market has been one of the major beneficiaries of COVID-19, apart from the healthcare industries, as well as the tech sector, obviously. Now, we've seen for 2020, for example, the average daily trading value of stocks on Bursa Malaysia doubled from 1.9 billion ringgit per day to more than 4 billion ringgit per day in 2020. And the trend has continued in the first quarter of this year, where you've seen the average for the first 2 months, for example, is actually more like 5 billion ringgit per day, which is actually quite an achievement, if I may say. Now, obviously, the shift towards equities has very much been driven by liquidity and the low interest rate environment. Now, this has also shifted some of the money into private equities as well. So the only challenge for private equities is in terms of the ability to conclude deals. That's limited, but the number of funds going into private equity has gone up tremendously. And even for many funds, the asset allocation has certainly gone up. And that's true to many of the investment organizations here in Malaysia too. So to speak more about the industry, we'll hear later from 3 speakers. But we will begin with Mrs. Lim. So Mrs. Lim, I would like to hand over the floor to you. And it's my pleasure to invite Mrs. Lim to share perspectives.
Thank you very much. Let me first thank Tan Sri Wahid for the very kind introduction and the organizers for inviting me to share my thoughts. I believe most people would want to forget 2020 and are trying to find hope in 2021. Okay. So allow me to dive right in and address the elephant in the room. What's the impact of the COVID-19 pandemic on the compelling Asian story? I would suggest looking at this through 2 sets of lenses. The first would be what are the widespread economic effects and the implications? And the second, which is a bit of a cheeky question, has the pandemic been used as an excuse for the pessimism or the inaction? So if we were to look at the pandemic, it's essentially a hard reset. It has a major impact on economic growth, most obviously in transportation and tourism and trade. And the most common consequence across all markets is a spike in unemployment, which in turn depresses consumption, even taking into account the various stimulus packages. But we can see through COVID that there has been an acceleration of offline to online retailing transition, and some of the migration is actually, to me, a permanent feature. We also see the disruption to a transformation of work arrangements with implications for real estate and public transportation. The COVID pandemic has also sharpened the central value of technology and the innovation that technology has enabled and will continue to enable. Now, there are both permanent and temporary or short-term effects that we should take note of. I asked the question whether there is an excuse, that the pandemic is using for unaddressed challenges. So we just need to look all around us, even outside this region, particularly in the US and the UK, at the inadequate infrastructure development that continues to be there, or the state of healthcare services, whether they are structured and priced appropriately, whether there is sufficient access to the different strata of society. And most obviously, we see geopolitics, including the deglobalization or even xenophobia, taking root and now being given the full opportunity to be fully manifested. And finally, there are climate change imperatives that were there anyway before COVID. So if we were to look at all these themes, the implications are that the alternate asset classes like ESG, technology, real estate, especially around data centers and logistics, infrastructure, they will continue to be growth drivers, and they will therefore feature prominently as well. Well, currently, for better or for worse, we see many government being pulled in all directions. And many governments are in a poorer fiscal position largely because of the substantial stimulus packages that have been trotted out, sometimes in a series, to save the economy, to save jobs, and to save politicians themselves. Taken together with an increasingly nationalistic, if not protectionist stance, there are implications for tax, investments, and the regulatory landscape. I expect governments to seek ways to raise revenues, bumping up existing taxes, and finding new sources like trying to tax online shopping from overseas suppliers, or with the hope of plugging the growing fiscal hole. Meanwhile, I just want to spend some time talking about the challenges that remain for tech regulation by governments. Now, these challenges will survive the pandemic because here we are talking about overlapping domains or even geographies in terms of markets. And governments are often in a quandary because they are accused of lagging badly because they have no clue as to what's going on, or regulating belatedly and harshly, or on the other hand, if they were proactive for stifling innovation. So we find government, I mean, to be fair, I think government is in a no-win situation. But this really need not be a zero-sum game with the government sort of bearing the entire burden. Governments should proactively collaborate with the private sector. And the good news is that Asia remains an attractive investment destination. Despite COVID, as you've heard from Tan Sri Wahid, record amounts continue to be raised by the large PE firms for Asia, and around a growing number of themes beyond the Asian regional theme into very specific areas. Now, certainly because of the COVID restrictions, there have been delayed exits and slower deployment. But nonetheless, I think most of the funds will continue to be focused on the following themes, which is by no means an exhaustive list. Now, some of the areas that I think they will be looking at will be things around, say, digital infrastructure. This will marry the importance of technology and digitalization that's going on across all manners of services or manufacturing. I think there'll be interest around ESG, particularly around renewables and power energy generation, waste management as well, around infrastructure, transportation, utilities, around real estate, again, a related theme around technology. So therefore data centers, logistics parks, and commercial real estate, perhaps in the gateway cities where there is sufficient liquidity. So like in cities in China, Japan, Korea, and Australia. But all said, I think the private investors would be treading very carefully, looking out for various sorts of risks, new risks or heightened risks. So the first would be in the form of xenophobic or nationalistic tendencies, and which may present heightened sovereign risks. The second is in the area of regulatory risks, partly because of the huge amount of technology innovation that continues to be found in the marketplace. So there's potential regulatory risk. And finally, a bit of sovereign but more political risk. It's rising populism and therefore short-termism, especially when, say, for like the big PPP projects, when government is the counterparty, then I think investors will be quite concerned about whether there is heightened political risk. So maybe one final comment that around sort of the venture cap space as well. I think startups or younger businesses would continue to encounter challenges given the ensuing rise in risk aversion amongst banks and venture cap funds. But nonetheless, I think the growth areas are still going to attract a lot of their attention. And certainly Asia is very much in play. Thank you.
Thank you, Mrs. Lim, for sharing your thoughts. If I may, you have written 2 books on the role of government in business. You mentioned a bit about that just now. But all too often, in many Southeast Asian countries, there is always that tendency for government to play a very prominent role in driving business and the business community, especially in sectors like logistics, telecommunications, finance, and infrastructure. Now, there is, of course, an important role for the government to play, but some people will argue that this can also be a hindrance to initiatives, competition, and development the private sector can bring. Now, to your mind, where is the line drawn, and how can we determine where that lies?
Mm-hmm. I think there are many contributing factors that should be taken into consideration. The first is the stage of growth of the economy. So let's say in the case of Singapore, back in the mid-60s, we had no foreign investments. So the government really had no choice but to be in every single sector driving and promoting growth. So in present days of growth economies, the government might realize that that's a growth potential, or rather there's growth potential in particular sectors like logistics, as you mentioned. But sometimes because the capex required is substantial, so there's a bit of market failure then. The government may have to step in to provide some of the anchor funding or to, to seed some of the ideas. Now, I think the problem that most governments have is overstaying their usefulness. So they go in with very good intentions, with very good motives, but after a while, they forget that they should be slowly reducing their role. And that's tough because for the public sector, there's nothing more difficult than to, to be the smart aleck saying that I think we should be reducing our exposure now. The status quo is actually the easiest to preserve. So that would be, I mean, if there's a takeaway, I mean, that I can leave with governments is to constantly examine when your usefulness is actually rich and to, slowly reduce your influence.
Well, thank you, Mrs. Lim, for that. Now, I can draw some parallel to Malaysia. For me personally, I think that the term government link has been overly generously used, where they seem to associate even EPF, PUAP, and PNB, for example, with the government. To me, if you were to go by the proper definition, only Khazanah's investments should be classified as government linked, because EPF and QAP, they are pension or provident funds, and in the case of PNB, it's a mutual fund management company. And I also believe that the moment any company is publicly listed on the stock exchange, it should cease to be defined as a government-linked company. So it is a PLC, basically, and the same rules will have to apply in that respect. So if I may now move to our next speaker. Now, Dr. Ganen will share his perspectives on private equity, some introduction into TPG in Asia, its presence, and the prospects of PE in Southeast Asia. So over to you, Ganen. Thank you.
Thanks, that's right. So I think to give some context, we're currently investing in Asia through 3 different funds. We have a Pan-Asia fund, which is currently 4.6 billion. We have a global growth fund, which looks at sort of smaller companies. That is a $3 billion fund. And we have an impact fund called Rise, which is a 2.5 billion global fund. So we really sort of distinguish between the Pan-Asia fund and the growth and Rise funds based on the companies are larger or smaller. And that's kind of how we deploy our money in private equity. In Malaysia specifically, we have actually had a long history. The Pan-Asia Fund's been around since 1994. But in terms of a Malaysian exposure, TPG were investors in Parkway Healthcare, which is now IHH Healthcare, between 2005 and 2010. And that obviously was the major shareholder of the Gleneagles hospitals and the Pantai hospitals in Malaysia. Also in the around the 2007 period, TPG had invested into Bank Thai and eventually had sold it to CIMB for equity, and so became a shareholder indirectly of CIMB. As part of CIMB's regionalization plan, and that became a sort of key component to what is CIMB today. Since I joined in 2014, we've actually invested in that period of time across different companies about 5 billion ringgit of equity. So that has comprised in the healthcare space. Our largest investment is in the Columbia Asia Hospitals, which we've partnered the Hong Leong Group to on a 50-50 basis to buy essentially a Southeast Asia hospitals business, but that has a predominant Malaysia presence, and the headquarters is in KL. We also have a investment in a Southeast Asia pathology labs business. So in Malaysia, you'd be more familiar with the Gribbles or Quantum or ClinicPath brands, which sit under this holding company. The business is across Singapore, Vietnam, and also has a presence in Australia and is looking to go to other ASEAN markets. But Malaysia and Singapore, in terms of number of patient episodes or number of tests a year, is about the same, except that in Singapore there's a slightly higher value to tests, and so the Singapore revenues are higher, but the Malaysian business is sort of growing at a faster rate. We also have, not typically done in sort of private equity, but done a few greenfield projects in specialty centers. So CBSKL, I think that's right, had mentioned before, is one of those. But we have since in the Klang Valley also have acquired a meaningful stake in Beacon Hospitals last year in the oncology space, and we also took over from a bank sale of debt the old HSC business, which was a part of Derby Park, where the company had gone into some liquidity issues, and the lenders were selling that, and we're converting that into a orthopedic specialty business. So in the Klang Valley, we would be in cardiac and vascular at CBS KL, in oncology via Beacon, as well as in orthopedics in the old HSC site in the Derby Park area. In education, we have invested in Sri KDU and Rail Schools. That was completed last year, and are looking to have that be part of a Southeast Asia platform, where the biggest K-12 school platform we have is in Vietnam, in Ho Chi Minh City, but also at the end of last year, early this year, early 2021, we acquired a school in Singapore called GEM Singapore, and really developing a Southeast Asia platform for that. In terms of Southeast Asia platforms, we also have an investment in Property Guru, where Singapore and Vietnam are the biggest markets, but Malaysia is the next largest market for the business. In fact, we hub all our finance functions for the whole group in KL, and our CFO sits there. As you know, it's from a cost effectiveness, Malaysia is extremely competitive with finance functions, and we're looking to kind of expand that platform besides sort of growing in Malaysia itself. We generally work in Southeast Asia in the individual countries with senior advisors. Hwee is I think that's right, mentioned a senior advisor to KKR. So similarly for us in Malaysia, we work with my ex-colleague Tunku Ali Radhaudin, who I've been working with since 2004. So he works as our senior advisor for Malaysia, and just given how busy we've been in Malaysia, we've added Wan Hafiz Hussain, who was ex-CIMB and Khazanah, to work with Tunku Ali, as we now have a number of portfolio companies and still on the lookout for other opportunities. So that's really a summary of what we've done in Malaysia. In Asia, just to give you a sense of what we've done since COVID, because I think that's always an interesting thing for people to have a sense. How do people invest post-COVID? What are the types of businesses we look to invest in? So last year we invested actually, since COVID, we actually invested more money than we did in 2019. So in 2020, which meant that it was a really busy second half, because obviously the Q2 was spent with lockdowns and all of us trying to figure out where the world was heading. Most of our investing activities were occurring for 7 months of last year, and to do more than what you did in 2019, it meant that 7 months was extremely busy. But we invested across all our different what I call countries or regions in that period. Our first investment was actually alongside a whole host of other large private equity firms, including KKR, in the Geo-Reliance series of capital raising, which I think was a record capital raising for India, where Reliance basically raised billions of dollars for Geo Platforms, which is a mobile business that they had created from scratch, and Reliance Retail, which is an offline-online business that they're looking to try and develop across India. We also invested in Korea in Kakao Bank, which is a lending business that was set up by the Kakao Group, which for those of you who might not be as familiar in Korea, but Kakao kind of has the equivalent of the leading messaging platform like WhatsApp. It also has the leading mobility platform, Kakao Mobility, where we had invested in 2017 along with Kakao Group, but also music, the equivalent of their Spotify, the equivalent of their Facebook platforms. So it's really an integrated, dominant tech business for Korea. And so Kakao Bank was a lending business that they had embarked on, and and we sort of invested in the latest round there. We also invested in 3 life sciences businesses in China. So there's a whole medtech and biotech revolution going on in China. We had invested earlier on, prior to COVID, in a very interesting keyhole surgery instruments business. And we've continued to now look at a couple, 2 or 3, well, we made 3 and looking at another 2 or 3 investments in the medtech, biotech space in China. And then in Southeast Asia, we made 2 investments. We made an investment in a life insurance business. So we bought Aviva's Singapore life insurance business. Aviva were selling that. Actually, as I was leaving Khazanah and CIMB bought Aviva's life insurance business in Malaysia. So this was the Singapore life insurance business. We merged it with a startup tech-driven business called Singapore Life. Really the objective there was to bring together 2 businesses, one that was very highly data enabled and a very strong tech platform into a more traditional life insurance business, but that was selling through a financial advisor network primarily. We invested in a milk business in Indonesia called Greenfields Milk. It's the largest fresh milk business in Indonesia. It's fully integrated, not unlike the business that Khazanah has invested in Malaysia called Holstein, which I think Tan Sri Wahid would love to see listed in Bursa Malaysia, but very similar end-to-end from the rearing of cows to the production of fresh milk in the fresh category. So that's sort of the variety of businesses that we've invested since COVID, the middle of last year.
Well, thank you, Ganen. TPG has always been having a reputation of a contrarian. Now, it's very interesting that you mentioned about the wide range of investments we've gone in. So how different would that be compared to the other PE funds or firms?
It's very hard for me to sort of compare that, because at the end of the day, I think people will have to make their calls, and you'll only really see it, I think, after the investments are made. But essentially, I think we've had, through COVID, a real ability to figure out where we think businesses are going to do better in. What's clearly happened through COVID is patterns and behaviors have changed. People are using digital means to communicate. They're using digital means to consume, but at the same time, some traditional things are being reinforced. So what do I mean by that? I think if you survey any parent of young children, I think they've reinforced their views that they need to send their kids to school and not homeschool, because homeschooling has had its limits around, sort of parental sanity. And so I think, it has reinforced the notion that, schools and that social interaction for children is pretty critical. It has, I think, reinforced the notion that in Australia, for example, our pet business has grown tremendously in this period, because as people have spent more time at home, they have chosen to get pets and get a degree of comfort around that. And obviously, when you do pet sales, you get the grooming services and the pet food and thereafter vet services that come along that with an annuity, right? Our specialized healthcare businesses have continued to sort of develop in that period, but cross-border travel for medical tourism has kind of come to a halt, right? So localized healthcare has had to kind of work alongside what is really telemedicine, right? Because some people who do see doctors across the border for specific consultations, have now had to consult their doctors digitally, and yet had to seek options in terms of medication or procedures that are urgent locally because of your inability to travel. So there are, I think, shifts and structural changes that have occurred. And what I do say that has definitely happened is a rapid move to digitization. So most of our companies are selling more online than they did before, and I think that will continue.
Well, thank you, Ganen, for that insight into PE in Asia and some of the investments TPG has been looking at. Now, if we can now move closer to home, we'll come back to Mrs. Lim and Ganen later for other questions. But Syed Yasir, I would like to invite you to now speak, and Syed Yasir will introduce Ekuinas and the PE industry in Malaysia, as well as its investment mandate and thesis. Over to you, Syed.
All right. Thank you. Thank you, Tan Sri. I could potentially describe Ekuinas in probably 45 seconds, but that wouldn't do justice given the uniqueness of our mandate. So if you could allow me to introduce and spend a bit more time in terms of what Ekuinas is all about. So Ekuinas is effectively a government-sponsored private equity. The term can be a bit oxymoronic if you think about it. Private equity and government doesn't quite come together. But yeah, we were created back in 2009, effectively, as a government-linked private equity firm. We have a unique aim because our aim was to create a sustainable Bumiputra wealth creation, as well as increasing Bumiputra participation in the economy as a whole, using a market-friendly method, effectively. We have a pretty unique mandate in the sense that we have to pursue two objectives. One is financial objectives. Our objectives is effectively to enhance institutional Bumiputra equity and at the same time generate returns. Our secondary objective is effectively to enhance Bumiputra participation across 4 dimensions, effectively, from equity ownership, management, employment, as well as creating value in supply chain. So if you think about these two objectives, they often contradict with each other. But what we're trying to do in the event that there's contradiction between the two objectives, financial objectives will always prevail. So we're not an institution where we disperse money without looking at returns and so forth. So I think it's very important to understand that. I think it's from mandate perspective, Ekuinas first and foremost is private equity that's pursuing a secondary objective. We do this via 2 key methods. Effectively, one is direct investment, where we undertake directly investment ourselves. These, by and large, has skewed towards buyouts and controlling stake. Currently, about 85–90% of our investment are in fact buyout and controlling stakes. The second one is outsourced fund, where our aim at the point in time was to develop the nascent private equity industry in Malaysia, where we outsource our fund to a third-party fund manager. We effectively target 2 key groups. One, entrepreneur to supplement their risk capital, who wants to take money off the table at some point after working hard for 20–30 years. And the other is we target professional manager, effectively for them to look at opportunity to potentially having some sweat capital and effectively try to promote entrepreneurship among the professional managers. To date, we have launched about 6 funds for both our direct as well as outsource. We have vintage year 2010, which was our first fund, and we are now running on our 4th fund. The first 3 funds are fully invested. First fund, in fact, was closed and fully realized. Fund 2 has been fully deployed. Fund 3 effectively as well, like I would say fully deployed. And Fund 4, we just made 1 investment earlier this year. The 2 outsourced funds currently fully deployed and waiting full realization of the funds. Okay, this is, I think we're a bit unique from structural standpoint. On the outset, we wanted to ensure transparency in terms of how we operate. So we were We were established based on typical global private equity firm legal structure, where we split the fund capital company from the fund management company effectively to ensure that proper accountability is effectively happening. The fund capital company will then have effectively entered into agreement with the fund management company to manage investment on behalf of fund capital company. On top of that, what we have created is investment by tranches following or based on vintage years. This is to ensure that upon closure of the respective funds, we could benchmark performance of each of our investment under each of the funds against either regional benchmark or local benchmark. Investment mandate is clear from our board to invest in high potential sectors within Malaysia. We started off with 5-6 sectors. We have since increased that to other sectors in line with time. We were one of the, Ganen mentioned that he has invested in education. We were one of the earliest investors in education in Malaysia. At one point in time, we have a portfolio of about 5 universities, 3 of which has been realized. We also invest in services. We have invested in companies such as Consortium Logistics. Again, that has been realized. Healthcare, we just started to look into it, a bit of a late entrant to this sector. We have earlier invested in third-party administrator company that manage claims for insurance company. Recently, we have invested in pharmaceutical distribution, industrial product, again, an area that we're looking at. Manufacturing, we have 2 investments in manufacturing. We have investment in E&E manufacturing out of a company that's owned by Singaporean but based out of Johor. Oil and gas, again, we have a heavy presence in oil and gas sector, effectively to reflect the overall key economic driver for Malaysia. FMCG, we have invested across in both F&B retail as well as sports retail. Technology is again another area that we have started to look at it. Our first investment was into a company called Trianglo, which effectively a airtime transfer company or money transfer company. And I think more recently we have made investment into web hosting company called Exabytes. From negative investment list perspective, we invest only in ethical business. We don't invest in gaming, legal, or other illegal activities. We don't invest in hedge fund or derivatives. Properties and construction, again, is an area that we avoid because I think there are too many companies in Malaysia, especially the one that owns by government-related company that's already in that area. We don't think we can add much value, especially for those type of company. We also don't look at startup or early stage and company with no Malaysian focus. So effectively, we are 100% Malaysian focused company. Yeah, so what's our thesis? I think going back to 10 years when we first started, I think when myself and the then CEO, Dato' Rahman Ahmad, when we were making rounds in terms of what do you think if we were to create a Malaysian-based private equity fund, a lot of us has written it off by saying that effectively there isn't enough opportunity in the Malaysian market effectively for you to be solely focused in Malaysia. And I think I'm glad to say that coming to 12 years after that, we have invested across 26 companies, and I think more importantly, we have exited 13 companies since that. Our investment thesis is simple. This was set up when we created the ample opportunity to invest in mid-sized Malaysian companies and transform and grow them into sizable market leaders and profitable investment. I think all private equity effectively go through this cycle. I mean, looking at industry, whether the industry is sizable enough, whether there's opportunity to consolidate, whether there's sufficient organic growth and regional expansion opportunity. We also prioritize ourselves to invest in freely competitive industry and try to avoid single client or single contract company. In general, we try to avoid company that's linked to government because that itself will pose a problem when we want to exit the business. So ability to exit is very important to us. a concession company will not be attractive to us, because that will limit our ability to exit when we want to exit at some point. Just like all private equity, we look at near market leaders with platform to be built into market, or platform to be built into market leaders. We look at unique company with unique competitive and sustainable advantage, good management setup. Our investment approach is slightly different from other private equity, because we recognize the fact that we are effectively a Malaysian-based private equity firm. And given single country mandate, opportunity to make 5 to 6 times may be limited. I think we realize that. So what we wanted to ensure is to form a portfolio that can offer sustained and consistent above market returns that meet internal targets while protecting our downside. So we try to look at the law of averages when we construct our portfolio. There are some companies which we know you can't probably make 3-4 times, but it's necessary for you to have in your portfolio rather than try to target 5-6 times money company, and the downside is pretty much unlimited. So we have a slightly unique and slightly different investment approach compared to most private equity. We also focus on control or sizable stake to ensure we can assert significant influence in a company that we invest in. We also look at company where we can spend a fair bit of time to focus on value creation, execution, and drive aggressive growth plan effectively. And from exit perspective, we are also looking at company that will secure premium for sizable or industry leader, as well as try to maximize return to ensure priority to Bumi equity and sustainability. One thing that also quite fairly unique to Ekuinas compared to other GLIC, in the sense that one, we are purely private equity. Secondly, we tend to be fairly involved in the company that we invest in. We have effectively 2 different divisions. We have investment as well as what we call portfolio monitoring division, where we spend a lot of time with our portfolio company to provide help across 3 dimensions. It can be strategic, operational, and financial. From our perspective, that is important. Of course, I think each portfolio company would potentially require a different kind of a system. Some companies will spend a bit more time in terms of strategic, how to help the company grow, to expand to new markets, to drive M&A acquisition. Some companies will spend a bit more in terms of to support them from operational perspective, help them in terms of pricing and revenue management, try to drive efficiency, including footprint consolidation or supply chain management and network efficiency. Some companies will spend a bit more time in terms of helping them to design the right capital structure, help them with their fundraising, and where companies started to face problem, we also help them in terms of restructuring and spin-off. Governance is a big part of our work as well. From a value creation perspective, we ensure that the company that we invest in has a proper governance. We spend a lot of time in terms of improving governance, instilling board committees, as well as ensuring the proper limit of authorities are in place. So I think in general, in a nutshell, that is what Ekuinas is all about. I just wanted to spend some time because I think it's useful, given the uniqueness of our mandate, to spend some time through this Ekuinas. So Ekuinas is, depending on how you look at it, you could look at ourselves as private equity with heart, or you look at, from some people's perspective, will view Ekuinas as being a government entity that is way too commercial for their liking.
Well, thank you, Yasir, for that introduction into Ekuinas. Now, I think certainly Ekuinas has done its part in terms of distributing some of the returns to Yayasan Pelaburan, Abu Putra, and so on. And if I may, if I recall the numbers in 2015, you were generating returns north of 20% per annum. So I'm not sure whether you're able to share the latest numbers. So that'd be useful if you can. in terms of the profitability of the funds? And also from your perspective, are there any particular investments which are memorable to you, very exemplary in terms of its impact and returns? Thank you.
Yeah, thank you, Dato'. I think 2015 is early years of our investment. I think quite a lot of investment has not been realized. We were making new investment at that point in time. I think we eventually managed to close our Fund 1 with about 11% return eventually. Our Fund 2 is looking at about 12, is currently tracking about 12%. But I think we are proud of our return in the sense that we have realized quite a fair bit of our return. About 80 or 90% of our return has been done through trade sale. It's not through IPO, where investors or buyers will require far more rigorous due diligence in terms of the quality of the company itself, as you can appreciate. So about 65% of our investment effectively has been realized. We only have about, at the moment, probably about 10 portfolio companies from 24 investment that we have started. So I think that itself is a testament, I think, a confidence in assets that Ekuinas has invested in, as well as testament of investors of foreign investors' confidence in Malaysia. Because from all the assets that we have invested and exited, roughly about 70% of our assets eventually were bought by foreign investors, whether it's strategic or private equity. So I think that itself is a testament of the work that we have done with our portfolio company. They find it's easy to do due diligence once we are invested in the company, because we have done a lot of the cleanup work compared to buying directly from entrepreneur itself. Memorable investment, I would say two particular investment in particular. One is Tanjung Offshore / Icon Offshore. The reason for that is simple. It's a real roller coaster of emotion. When we first invested in 2010, not many private equity were really looking at oil and gas in particular, because given the cyclicality of the industry itself. But we felt that it's a sector that, as a Malaysian-based firm, it's not something that we could avoid, especially if you're talking about trying to help Bumiputra entrepreneur, because that's where Bumiputra entrepreneur has the largest presence in the oil and gas sector. So we did invest in the company in 2010, 2011, a total roller coaster ride for me. Investment thesis on paper was fairly sound, helping a growing company who's looking to diversify into, they are effectively an offshore supply vessel company, but they were looking to diversify into services, right? So because effectively moving, effectively OSV company will require quite a fair bit of capital for them to continue to reinvest. So they wanted to move to services, asset light, and so forth. But I think the problem back then was that the then management was using the same management that was previously involved in trading business to moving into higher value-added business. So cost management perspective wasn't there. There wasn't any robust process from them from looking at investing into certain segment. As a result of that, 2 years after we have invested in the company make a huge losses. And at that point in time, I think it was a perfect storm, because Petronas at that point in time was also effectively relooking at their accounting system. So that resulted in effectively delay in payment. So we used that opportunity effectively to talk to our partners, the shareholders, try to see whether we could come into a situation that we could split the company. Because what we felt is we didn't want to put more company from rights issue perspective, because obviously our partners were saying, hey, what do we call for a rights issue and put more capital? Because we didn't believe that the management has the necessary skill set effectively to move into that direction. So we felt, okay, if you believe in your services business, you say, what do we part with? So what we did is we did a demerger exercise. We took the OSV business and effectively the services business is left with a listed company. We did a demerger exercise. We found another company which we could merge in effectively. So our investment at that point in time, from looking at a fairly large losses. Eventually, after we merged and effectively listed the company, eventually it generated about 4 to 5 times money of the initial capital that we invested. But again, it's a cyclical industry. And like I said, roller coaster emotion. Then what happened was the oil price tanked, right? So we were quite fortunate to list the company when the oil price was about $120, which was, I still remember, it was June 2014, before eventually dropped to $20 per barrel. So it was, again, we were looking at a huge, I mean, we made 4 or 5 times capital, but I think we were scarred. I think it's our reputation. People were wondering whether, hey, what is Ekuinas doing? And I think that's the view of general public. So we stumped it up for another few years. And eventually, one of the other exercises that we did, I took the hard call to put the company under CDRC. I got a call from bankers. Bankers called me, Yasir, what are you doing? I mean, you are effectively a government-linked company. You can't put it under the CDRC. I said, look, I got to do what's right for the stakeholders. Effectively, it's the government's money that I'm managing. And if it's the right thing for me to do, I got to do that. Plus, I don't own any bank. I don't have to save any bank by try to bail out banks. So that was how we view it. Then eventually, I think I'm happy to say that the saga has not finished. I mean, clearly, happy to say that we eventually completed this corporate debt restructuring exercise. Eventually, the company was capitalized through a rights issue that was completed last year. And since then, we have also grown the company. And I think our most recent exercise, we took advantage of a situation, a distressed situation of another oil and gas company. We bought a drilling rig that was built for $200 million US, roughly about 5 years ago, for $40 million US from a Singapore-based bank. So I think we are quite confident. We are putting the company in the right platform. So hopefully the cycle works in our favor, but it has been a roller coaster emotion for me personally, because I was involved personally in this transaction. The other one I have to say is Al Ihsan, our investment in Al Ihsan. Slightly different story. It was probably one of the first company that I have approached when I joined Ekuinas, but it took me 6 years to close the transaction. It was the longest transaction that took me to close, I think, because it was founded by a entrepreneur who's done very well himself. He wanted to see whether he could institutionalize it himself. I think to a certain extent he did, but I think after 6 years, I think there comes a realization that I effectively need another partner to help me to take this company to another level. So I think those are the two most memorable investment for me personally.
Thank you, Yasir. I noticed that Tuan Haji Alia Hassan is listening to us. I think he's in the participants list. So thank you to all of the 3 speakers for sharing their thoughts and perspectives. Now later we will get some questions from the audience. So if I could invite the audience to actually use the Q&A box to log in your questions, we'll pick it up later. But before that, ladies and gentlemen, for us at the Economic Club Kuala Lumpur, we do believe in mentoring our youth to become our future leaders. And as part of that mentoring culture, we are pleased to invite our ECKL Treasurer, Jonathan Ong, to pose some open questions which he has gathered from the youth. So over to you, Jonathan.
All right, thanks very much, Tan Sri Wahid, and thank you, speakers, very much. So I will just kick off with the first question. So in recent years, private equity has had an increasingly negative perception in the West, especially amongst legislators. This is very much due to a number of factors, namely increased questioning of how carried interest is taxed, the equality or rather lack thereof in the process, and also perhaps questionable practices such as the overloading of bought out companies with debt to pay off dividends rather than reinvestment, and also what is deemed sometimes as reckless cost cutting, which sometimes results in the erosion of the underlying business and also job losses. However, in Southeast Asia and also largely in Asia, this is not yet the case in Southeast Asia, where private equity has a much more benevolent outlook as a builder of business and also grower of the economy. So how can the industry in Southeast Asia ensure it stays this way? Perhaps Mrs. Lim, you'd like to kick off?
Sure. I will be making more general comments rather than specific ones, and certainly Ganen can follow on later on. I think if you look at the private equity space, it has actually evolved substantially over the years, and the themes have changed, the methodologies have changed, and where you can have like core investments that have unlimited sort of a timeline. You now largely have a lot of funds that have a specific time life, which therefore means that there's a specific window for both investment and exits. And that, I think, would shape the behavior of private equity firms the world over, whether it's the US or even out of Southeast Asia. Likewise, I think the regulators would have to try and see how best they can participate in the benefits, right? And most of the time, I mean, tax regulators will tend to think that these are just ways of bypassing, taxes and minimizing taxes. But if they, as the private equity industry continues to evolve, I think the tax regulation side also will have to keep pace and to ensure that they actually have an equitable way of ensuring that some of the benefits are rightly returned in a way in terms of tax payments to the economy at large, so that you can grow, the entire economy without one part just monetizing the benefits and getting away with unequal sort of benefits. So I think it also varies from country to country. In some countries, there's no, say, capital gains tax, but then if it's investment, you would have taxes ascribed to it. Some governments have investment schemes that have incentives as well. So it is not surprising to me to see how PE firms will then have to find ways of situating the funds so that they can best sort of benefit from it. Yeah.
Thank you very much, Mrs. Lim. Perhaps Ganen, you'd like to go?
Yeah, look, I think the debate has generally been in certain countries around compensation and how they're taxed, and in most jurisdictions that have a capital gains tax regime, this really comes through around whether income needs to be capital gains taxed or taxes income or capital gains. I think in jurisdictions where capital gains are free, I think there's been less sort of controversy around carried interest and how that goes. But just taking a step back a little bit around private capital, I think if you actually step back and see the amount of private capital that has gone in the last decade, much of it has gone to fund the growth of what I would describe as the new economy, right? So, digital companies all around the world, whether that's the US or in Asia, they have been created and they have been funded by private capital for all intents and purposes. You're seeing now over the last couple of years, a number of them move or transition into public markets as they list, and those private capital providers are then able to monetize or at least get back some of the capital that they've invested. I think the age-old approach of a buyout and use of leverage and cost cutting has really been a fraction of the overall private investment market in the last decade all around the world. The numbers are really glaring in a market like China. In China, which is sort of 50% of the private capital investment market in Asia Pacific, half of that has really gone into sort of what I would describe as tech-related investing, right? So things that are denominated around that. So I think this barbarians at the gate notion of private equity is really a thing of the past, and it doesn't really demonstrate what the reality of what has occurred. Cost cutting is obviously going to be something that private capital owners will focus on at the appropriate time, but that typically comes after the investment in growth. That's really kind of my observation of it.
I see. Thanks very much for those perspectives. And Tuan Syed, maybe you want to comment a bit?
Yeah, for me, it's a different dynamic between these two economies, the Western economies as well as the Asian economies. Western economy is very much a mature economy. If you look at issues regarding compensation as well as capital gains and so forth, it tends to benefit, at least in the Western economies, tend to benefit the elite class because the economy is mature, is seen as benefiting one class of the society, while it occurs in market like Asia. But if you think about it, Asia is effectively a rising income economy, while private equity or general private equity professionals get richer, the spillover effect on the general population as a whole is far, far larger than what it was. Because I think what happens is everybody becomes more affluent as a result. And we do see this across all Southeast Asia country or Asia Pacific country in general. So the capital has effectively benefited a larger group of people because coming from a developing economy growing into more developed economy. I think that's my observation. So in terms of hatred towards private equity or feeling that private equity is taking away their job, I don't think such notion exists in Southeast Asia.
I see. I'll move on. Thank you very much. I'll move on to another question from the youth. So it's the buyout versus partnership principle. So a lot of Southeast Asian firms, especially Malaysian ones, tend to focus on partial buyouts in tandem with management and/or the original owner. For example, Ekuinas investment in Al Iksan and also Credo's investment in Mr. DIY, with the firms doing capacity building and marketing for the firm, which usually retains majority, if not very substantial, family ownership. This is very different from the US and to an extent UK approach, where there's an outright change in control and usually a delisting. Given the rise in the professionalization of management and also the decrease in sometimes family ownership here when during the change of hands and all that generational shifts, might we see this outright change of control approach become a more regular occurrence in Southeast Asian markets in the future? Dato' Ganen, Ganen, do you want to take it?
Yeah, look, I think it really comes down to the business that you're looking at and the ownership structure of the business, right? So if you look at businesses that have scaled, like Grab, for example. Grab is a great example of a founder managed business where the capital has actually gone into the company to allow the company to rapidly grow, where the founder's original stake, effective ownership is probably shrunk through the many capital raisings, to not be a majority, but is very much in control and driving that company, right? So I think that's a good example of one. There are many investments that we've made, whether it's our labs business, where our CEO was really a founder of a smaller lab. We put it together. He's now a smaller shareholder of it, but he runs the business, right? So I don't think the idea or the notion that private equity going in will mean a controlled buyout is a universal factor. It really comes down to who is in charge and what they want to do with it. You do have situations where people want to exit. Like in Colombia, Asia, the Beatty family that had built that business over many number of years. Dan Beatty was getting on in age and his kids were not keen on continuing in that business. there they wanted to completely exit and sell out. And so private capital, private equity gives them a solution to do that. So I think, for most players here, and I don't think that's, peculiar or rare to us, is everyone's willing to look at the set of circumstances and figure out what the objectives of the individuals want to do. And in some cases, the partnership may actually be where the founder has a smaller stake, not for anything else other than more capital is needed to expand and grow the business in a greater scale.
Can I just add on that in many of the growing economies, a lot of the sectors may have regulatory limits to shareholding. And sometimes the only way for any sort of foreign private equity investor to get in is actually through, or rather through keeping the local partner sort of in place. And particularly if the local partner, himself feels like he needs capital to grow, there's a lot of potential. And if there's agreement on that, then actually that might be the best outcome rather than a complete buyout.
I see.
Yeah, I think from our perspective, we believe there's no either or type of model. I think both model could potentially work. We have done both minority as well as buyout. We tend to prefer a buyout. When we talk about buyout, it's not necessarily 100% buyout, but buying a controlling stake in the company, because then we are in driver's seat. We can control exits. I think the issue about buying a minority interest is you effectively have one exit, right? Effectively, you either IPO the company or enter into a structured deal with the owner itself through a put option arrangement, which we think is always not ideal. Having a minority from our perspective, we don't go below 20%. Minimum is about 20%, so that we have a fairly significant influence in the company itself. Having below 20% means that it could also mean you're just a passenger in the deal, and hopefully you'll exit. Because we've seen that. I mean, some private equity has been stuck for 10 years and couldn't exit, I said, because they couldn't agree on what valuation they should IPO. I mean, we've seen that example in Malaysia as well. So we try to avoid to be in such situation. Try to ensure that we can control effectively the exit process itself. The only exception which we make is investment into technology company, because technology company typically goes through few funding rounds and generally only minority stake available.
Okay. Thanks very much. Okay, I've got one last question which we've collected before I'll move on to and I'll hand back the floor back to Tan Sri Wahid to open the floor to the Q&A from the general audience. So here's a stat from your old firm, Ganen UBS. So in the APAC region, ESG funds have reached, as of June 2020, $62.8 billion US dollars, while assets in ESG-linked EFTs domiciled in the region have increased dramatically from 1.56 billion US dollars in first quarter 2018 to 7.01 in Q1 2020. And in this regard, ESG investing is generally gaining more and more traction from the actions of big activist investors, like what we've seen with BlackRock in Malaysia quite recently, and also even in Toshiba in Japan, where the management lost an unprecedented EGM. So could this trend have hidden opportunities for private equity and indeed buyout firms seeking to differentiate themselves and also gain a presence in a very new but increasingly important market? Open to the floor to the speaker. Mrs. Lim?
I'm afraid that in certain sectors, whether it's tech or ESG, we could have too much money going after too few deals, which unfortunately will drive valuations up and may lead to unrealistic sort of growth plans. So for example, I think vertical farming is like the rage these days, right? Because it provides the solutions on so many fronts. So this is a bit of a situation where I would expect PE investors to really be quite mindful of the real benefits, the real ability to realize, all the projections that have been made out there, and then to ensure that you have, usually because the entrepreneur will be your partner, that you have a good partner to play alongside as well.
I see. Ganen, maybe grab your take as well.
Yeah, look, several years ago, TPG looked to set up a impact fund called Rise. That was sort of one of the first impact private equity funds. It's now raised its second Rise fund, and that continues to, have two criteria to it. We look for financial returns, as we need to for all our investors, but every investment needs to satisfy an impact analysis that we do. And we've worked very hard to create something that was measurable, that the investing community would accept. So in developing that measurable impact calculation, we set up a unit called Hwee Analytics, who now actually provide a service to our other private equity funds. So we are looking at impact and the evaluation of ESG to go beyond just our dedicated impact funds. We're also trying to have that impact analysis, or at least the ESG criteria, to come through with our regular private equity funds, because I think we all want to try and do good as we invest to the extent that is possible. We're now launching, it's public now, so I can talk about it, but in partnership with Hank Paulson, who used to be the former Treasury Secretary in the US, we're launching a Rise Climate Fund, which is really dedicated towards climate investing. It's something that we had previously worked with John Kerry on, and he's now in the US government. It's a real push to try and see that we can get more and more private capital into climate investing, which is obviously becoming increasingly important for all of us, and we'd like to try and channel private capital into those initiatives around the world.
Tuan Syed?
Yeah, I think from our perspective, I think we invest in whatever makes money. We are a developing economy after all, right? If you think about ESG perspective, if you were to look at from environmental perspective, there are a lot of companies that we couldn't invest in. So I think from a developing country standpoint, there are a lot of things that need to happen first before you talk about environment per se, right? I think the level of income, the quality of education need to be increased. So we rather spend our gains and money in those initiatives. So we don't want to be involved in sloganeering, because I think there are a lot of sloganeering in the ESG space. People use it to attract more capital or to have higher valuation on their investment rather than doing good for the environment itself. So what we can do is, what we are in fact initiating is try to focus in, although we invest in companies that say in fossil fuel, what ways can we do to reduce the carbon footprint, right? Rather than just say we invest in purely ESG or environmental friendly company, we look at ways where we can do good through our initiatives in our portfolio company itself, right? Because I'm afraid that it becomes too much of a sloganeering in the investment universe, effectively, where people try to attract crazy valuation for business, where people try to raise fund for, basically people who are conscious with ESG initiatives.
I see. Okay, thanks very much, speakers. And over back to you, Tan Sri Wahid, and we'll open the floor to the audience for Q&A. Please type your questions into the box, and we'll be able to see them from there. Thank you very much.
Thank you, Jonathan. If I may, Mrs. Lim, Ganen, and Yasir, We have two questions from the audience so far. The first question is on healthcare. Well, while private capital is bringing innovation to healthcare through new delivery models, technologies, and operational efficiencies, there is another side to investors entering healthcare. The impact of their common business model of buying, growing through acquisition or roll-up, and selling for above average returns is cause for concern and probably unsustainable. In many countries, healthcare costs has escalated tremendously. What are the panel's views on this? And to what extent does this scenario apply to Malaysia, especially the private healthcare sector? So I open this to anyone.
I'm happy to try and make a stab at it. I think, if you step back and look at it, it's very interesting that you now have a length of time to watch, one of the, I think the most successful public healthcare systems in the world, the National Health Service in the UK, sort of unravel and the challenges that they observe. The reality, I think, if you step back and think about costs and rising costs and its impact on society and its impact on people in society, you have to figure out whether or not keeping a service like healthcare purely in the public sector in the aim of actually providing affordable healthcare is the solution, or is this better managed in a private setting? Obviously, proponents like us who are investors in it would argue that when we're managing something, we're managing it more efficiently, we're managing capital invested in it more efficiently, we're managing it in terms of construction and development of your healthcare assets more efficiently, and we're trying to minimize costs to middle agents that kind of cause rising healthcare costs. I do think, though, that the point that you're making is something that every government has to watch out for, right? Rising healthcare costs, where there is a degree of gorging. And in some countries, that is kind of sort of managed by providing guidance on pricing with respect to what doctors can charge, and also insurance companies provide and third-party administrators provide guidance on what hospitals can charge. And I think that does work reasonably well on a median. But I still do believe that the private investment market has a role to play in managing capital, in managing costs, to actually provide affordable healthcare. And one of the reasons we found Columbia Asia to be a very interesting hospital model to invest in is the founders were obsessed about trying to create private healthcare in an affordable setting versus premium healthcare in an expensive setting.
Maybe if I can just jump in to say that I think it's quite instructive what's happening in the US, where we went from Obamacare and then it got dismantled, or the Trump administration tried to dismantle it, and now we're back to Affordable Care Act, which is Obamacare. So I would not disagree with Ganen that I think private delivery tends to be more efficient because of just the inherent nature of public services. But the government, at the end of the day, has overriding responsibility over access coverage, especially of the lower income, as well as affordability. Now, how it wants to use the different levers that it has to effect this, either by controlling prices or imposing sort of mandatory coverage, I think that probably would have to vary from country to country. It's really, I think, down to what, at the end of the day, the ball is in the government's court.
Thank you, Mrs. Lim. Yasir, anything to add?
Yeah, well, not much to add, really. While I agree in terms of private healthcare help in terms of efficient delivery of healthcare services, but I think throughout this pandemic, you could see that the role that private it rendered them almost totally useless, right? I mean, if you look at a lot the situation that are happening around the world, is effectively the government that effectively a government hospital, whether it's in Malaysia, Europe, everywhere else, have to step up. I think people are just being shunned away from moving into or rather going to private healthcare service provider. So in that sense, there's this contradictory. While private healthcare is required because it's more efficient, but at the same time, I think government need to spend more on effectively on public healthcare services to ensure that equal access of healthcare, equal quality access of healthcare is available to public in general.
Well, thank you, Yasir. Likewise, man, I do share the view that there is the role for the government to provide that universal healthcare, and there's also the role from the private sector to provide alternative, whether it's premium or affordable private healthcare, but allow people that choice, if you like. Anyway, the second question, very specific to Ekuinas, does Ekuinas have any funding requirements at the moment? Grants from government repayable at a set interest rate? Quick one, Yasir.
Oh, okay. We're quite fortunate in terms of our capital comes from government in the form of effectively equity injection. So it's not effectively money that we need to borrow from government. So it was allocated roughly about 4 billion ringgit over the period of almost 10 years. So we do not need to return those capital as and when we exit or close our fund. What we do is the capital will be reinvested and the gains will be distributed for Bumiputra purposes. I think as Tan Sri Wahid has mentioned early on, our gain from Fund 1 was effectively distributed to Yayasan Pelaburan Bumiputra.
Thank you. The third question, with the record low interest rates so far, are PEs planning to look to perform more leverage buyouts in the near to medium term? Why and why not? Maybe Ganen?
I think interest rates have remained pretty low or benign, going now for 13 years since the global financial crisis. I think post-global financial crisis, we never really saw a substantial step up in interest rates. So I do think that, as you've seen, buyouts occur from time to time. Buyouts will continue to occur. I do think that lots of investors do expect a step up in rates over a period of time. But we are in a world where most central banks are keeping interest rates relatively benign as long as inflation is under control.
Oh, thank you for that. Well, ladies and gentlemen, it's now 12 noon, and I'm afraid we've come towards the end of the session. But before we close the session, may I invite each speaker to deliver their concluding remarks in terms of what are the opportunities and challenges for private equity in Asia. Let me perhaps request maybe Ganen to go first, followed by Yasir and Mrs. Lim. Ganen? Yeah,
I think very quickly, the biggest challenge right now is trying to figure out whether these valuations in public markets, as Tan Sri Wahid alluded to, it's a sort of record volumes in public markets, and public market valuations tend to then influence, buyers and sellers around what private market valuations would be. Is how long they are sustainable for, and are they a benchmark that we should be using going forward? So that, I think, is the constant challenge. I think finding good companies with good prospects for growth, or good prospects for reconfiguring and making them productive or more efficient, that will constantly be there in different firms, and different people will find different angles. And so I think that will continue to be something that that people will work for. I think the biggest opportunity, to be honest, for governments to consider is you now have had a number of years of private investing, returning capital over a period of time. finding ways to make it accessible to retail investors and how they may be able to invest in this product is always something that's I think governments need to kind of think about. In the US, a lot of private funds like Blackstone have made their products available to retail. But in most other markets, it's really limited to high net worth individuals. So I think if you can find ways, I know the Singapore government has tried to do it with Azalea and these bonds that they've issued, but if you can find ways to allow retail to have that opportunity to invest, I think it's it just makes the product more accessible to people to be able to get returns that typically have done better than public returns. Thank you, Ganen. Yasir?
Yeah, I think I start with challenges first. I think I agree with Ganen. I think valuation is a big challenge for a lot of private equity firms. It's sky high now. I think to find the right opportunity to support the valuation requested by a lot of businesses are challenging. The other area is adaptability to new normal. Question mark, what is that new normal? So that is what we're struggling with, right? What is business model? How is business model going to look like post-pandemic, right? I mean, a lot of people talk about digitalization, but what do you mean by digitalization? In what sense? How can you help your portfolio company pivot to adapt to the new normal? I think those are the two key challenges. From opportunity, we see a lot of opportunity in technology space, digital infrastructure. I think Mrs. Lim has mentioned that earlier. The other area that we are looking at also is distress assets, as well as recovery play for some of the companies. I think in a nutshell, those are challenges and opportunity that I see for 2021.
Thank you, Yasir. Mrs. Lim?
Yes, I see increasing polarization of investments. So on the macro scale, we have on record amounts that all the different PE majors have raised. Even if they are by themes, they are still by very specific themes. What it means is that the bigger the fund size, the bigger the ticket price for each investment as well. So which means that they will tend to focus more on the larger companies, the more mature businesses as well. At the same time, we have banks who are the usual credit providers shying away, well, understandably because of a very difficult COVID situation. So they tend to be a little more risk averse. So I think that it will be between the haves, who are in this case all those that belong to the sexy businesses of ESG, tech, digital, or anything, who have no shortage of pursuers, who have no shortage of people chasing up the valuations for them. I'm a little concerned about the space for the smaller operators who may be doing very sensible transformation businesses out of brick and mortar businesses, but they may find it hard to actually raise funding because they are not big enough for the PE funds to notice them, and for the banks to want to invest in them, and not big enough to attract the sexy themes or to be incorporated under those popular themes as well.
Thank you, Mrs. Lim. Well, thank you to our three speakers, Mrs. Lim Hwee, Datuk Ganen Sarvananthan, and Syed Yasir Arafat, for sharing your insights into the opportunities and challenges in 2021 for private equity in Asia. I hope the audience has found this session useful. I'm sorry that we have extended beyond noon, but I'm sure it's very much time well spent. Thank you to our young co-moderator, Jonathan, for co-moderating, and thank you to Tan Sri Michael Yeo for his opening remarks. If I may end, I mean, I don't intend to summarize, but I always believe in all of us living up to our purpose. And for the private equity firms, and I tend to apply the definition generously in terms of private equity, meaning it's private investments, whether it's angel capital to or seed funding to venture capital to private equity. It is all within the context of helping businesses grow at the various stages of development. And to me, if every single one of us were to play our respective part, I think, God willing, we will be able to fulfill our function, grow the business, create opportunity, create employment, and at the end of the day, once the businesses are ready, it will enable the private equity investors to exit and go into the public equities domain by way of listing on the stock exchange, for example. And that is also part and parcel of the wealth creation process. So with that, it is my hope that the private investments business, private equity business in Malaysia will continue to grow and will continue to feed the stock market, the exchanges like whether it's actually Bursa Malaysia or SGX or IDX or Thai Stock Exchange to be able to actually grow and at that point in time allow the public investors to come and invest in these entities. So with that, ladies and gentlemen, again, thank you for your contributions. We do appreciate what you've done. And to the audience, thank you. Wish you all the best. Thank you.
Thank you. Thank you, Tan Sri.
Thank you.
Thank you.